Welcome to Market Monday from the investment team in the trust department at the First National Bank. We're going to kick things off today with some reflection on end-of-year markets and the likely conditions. So, as we enter the home stretch of 2024, which that's kind of tough to believe we're already here, but we are, people are going on their vacations and stepping away. So you tend to see lighter participation from the major market participants, the trading firms, trading desks, the investment banks, the brokerage firms, etc., and institutional investors. And even in terms of the individual investor as well is focused elsewhere, basically preparing for their holiday celebrations. So as a result, we have a lot less participation in the markets in the last couple of weeks of the year because of the holidays coming next week. And that means that there is potential for enhanced volatility. The idea behind that is that there is a thing called market liquidity, which describes the conditions of the depth of buying and selling activity, people that are in the market looking to transact. And when that declines, volatility tends to increase because there is less order flow at any given level of the market that's going to stop it from moving further. So if we get unexpected news items, whether they're economic news releases or whether they're related to geopolitical events that are pretty extreme lately and that are expected to remain extreme, we could see exaggerated moves that aren't necessarily warranted by the information. So we're going to be on guard for that. And with that in mind, let's go into the economic data expected over the next couple of weeks. So what we're seeing here is, today we just got Empire Manufacturing, which came in a little bit low, and that's contradictory to a lot of the strong data that we've, seen recently, which suggests that the overall economy is growing very quickly and potentially, with some inflation. We'll talk about that a little bit more. Retail sales tomorrow, that's expected to show pretty substantial increases when you take out automobiles. And, if your retail sales is growing like this is a demand metric, retail sales being 2/3 of GDP growth, that says the economy is essentially going to be expected to be much stronger than it was in the prior period. So a strengthening economy, is that consistent with the Federal Reserve lowering rates at the next meeting like they plan to? Maybe not. We'll talk about that in a few. But, we get industrial production, we get capacity utilization. This is more about how the market's functioning, housing market, and then we'll get the Federal Open Market Committee's rate decision on Wednesday. That is basically expected to come in at another quarter-point rate cut. And we will get a dot plot, which is showing what the Fed's expectations are in aggregate over longer periods. And what this does is, if you look carefully, they're actually hiking their extended period forecasts of what inflation and thereby as a proxy, their overnight rate is going to be in the longer term. So they're implicitly saying, hey, we're expecting higher rates down the line. And is it even appropriate for them to be doing this quarter point cut? They've already cut quite substantially. And if we look at the core PCE, when we saw that the last time, it's starting to rise. So this is their preferred metric. That stands for personal consumptions and expenditures, and the core strips out volatile items. But that number is rising, and that's the Fed's preferred metric to say, hey, what does inflation really look like? And that's pretty close to 2.8% as of the last reading. And if that continues to come higher, it calls into question the wisdom of another rate cut, or even the level that we've cut them to as it is. So we're going to be watching that pretty keenly, and especially when we get out GDP, that's expected to show no revision. We're going to see personal consumption, which is coming higher. Again, that's a signal of strong economy, not weaker. We get the leading economic indicators index, which even though that's a slight negative, that's also expectations for strengthening. Labor market, we're going to get information about spending and income, which is huge. That's expected to show a little bit of a decline in income, but an increase in spending. Maybe that happens, maybe it doesn't. It's germane, though, because this tells us what's likelier to happen with consumer spending and thereby GDP. We will get that core PCE again. That's expected to show a climb on the year-over-year basis. So again, is it really appropriate that they're going to be cutting rates? We're not convinced. We'll get a sentiment indicator. That sentiment leads to consumer spending, etc. And then again, consumer confidence. That one leads to consumer spending. So all of this stuff is going to be pretty informative as to what's going to happen throughout the economic front early into next year. And durable goods, that's expected to show a pretty good decline. So this is another contradictory data point with all of the rosy data that's been expected in other areas. A shrinking in the durable goods orders would suggest that consumers are becoming more cautious, and other information has suggested the opposite. So it's really unclear right now what direction things are going to take, but we'll be watching carefully. As to the S&P 500, that continues to sit up here right near all-time highs, and it's not expected to do much. It hasn't been doing much, throughout the end of this year. And the reason being is, again, there's not a lot of activity expected unless there's some major catalyst with regard to economic data, with regard to the Fed decision, with regard to the geopolitical events going on. Other than that, we expect a relatively flat, placid market at this point. Rates have come up quite substantially from the beginning of the year, even though the Fed's been cutting, and they're coming up on the longer end of the curve. And that's largely because the shorter end of the curve has come down in response to the Fed's pressure cutting rates. But inflation expectations, which is really the only pricing input into yields on the Treasury, that's gone up over the longer term. They're saying that these lower rates on the overnight level are going to stimulate the economy, leading to eventually higher inflation and higher rates over these 5, 10, 15, and 20-year periods and so forth. We're watching the yield curve. That's actually an interesting point. The corporate curve as well, this one's got a much sharper slope on the curve. In other words, it's going up quicker as you move out in the maturity. The maturities are raising by about a comparable amount. 10-year paper over here, 37 basis points versus 49. This suggests to us that corporate credit risk, in addition to inflation expectations, are also rising. So we are going to be watching that pretty carefully. But in the context of a strong and continuing to grow economy, that's not that bad of a situation to see. It doesn't augur any real problems. The default rate in A-rated corporate paper is well below 1%. So, and that's over long periods of time. So we're not seeing signs of stress in the credit markets. We're not seeing signs of stress in the equity markets. And, it's a rather unexpected year. We were expecting a lot of more chop and certainly not this lockstep that the markets just continued to go up. Volatility expectations, that's turning up here, and this will be interesting to watch. If we were to zoom out, you would see that volatility tends to spike. We see an example here from over the summer where it just spikes from a low level and goes really high really quickly in response to some exogenous shock. So even though we're down here low, we can't get complacent with volatility. Does that change our long-term plan, though? Not really. I mean, when you look over the longer term, there's volatile periods where markets have gone down. Most of the time, it seems to be going up over the past 20 years, and we're going to continue to do what we do, which is adhere to our long-term investment plans. So if you have questions about the market, if you have questions about the economy, or your accounts, feel free to call us. We love to talk about this stuff, and we're going to be here through the holidays. Well, with the obvious exception of when the markets are closed. But other than that, hope you found this video useful. Thanks, and have a wonderful holiday season.